Okay, imagine this for a second. According to ancient biblical teachings, if you're earning interest from your savings account, your investments, you've technically violated a commandment.
Wow.
This is pretty wild.
That's a really stark contrast to today.
Exactly. So today we're doing a deep dive into how charging interest, which used to be condemned as usury, how it went from being seen as a moral sin to, well, an absolutely essential part of our modern economy.
And that's the core question, isn't it? What exactly changed? How did such a fundamental ethical stance just flip?
Right.
We'll be looking at insights from sources like an article from Heresy Financial hosted by Joe Brown called How Interest Became Moral, Why Usury is No Longer a Sin.
Yeah.
Trying to trace this, fascinating evolution in money and morals.
Yeah, our mission here is to unpack the kind of surprising facts and the really critical shifts behind our financial world today. So you can grasp not just what happened way back when, but why it actually matters to how you see things now.
Absolutely. It's more relevant than people might think.
Okay, so let's unpack this first part. The biblical condemnation of usury. It's hard to get our heads around now, but why was it considered so fundamentally wrong back then?
Well, you really have to put yourself in a completely different monetary world. I mean, for over 5,000 years, money wasn't like it is today. It was gold and silver. Tangible stuff.
Right. Physical assets.
Exactly. These were hard money standards. They had intrinsic value. And crucially, their supply was limited. You couldn't just print more. You had to mine it.
And that hard money context, that scarcity, that made all the difference for how the economy worked, didn't it? Like, what did that mean for prices?
It's the key. And this is where it gets kind of mind-bending for us today. In that kind of economy, because of things like technology improving, productivity getting better, prices generally fell over time.
So things got cheaper.
Yeah, on average. It wasn't about recession or anything like that. It was just progress made things more abundant relative to the fixed amount of money.
Yeah.
So you had this sort of natural, gentle, deflationary environment.
Okay, wow. So if you just held on to your gold, saved it, its actual purchasing power would increase all by itself.
Precisely, which means if you lent that gold out, even at 0% interest,
You'd still get back more value later on.
exactly, because the gold you received back could buy more goods, more services than when you lent it out.
Okay, now I see it.
So in that context, charging interest on top of that natural game, well, it looked exploitative, like you were taking advantage often of people who were already struggling and needed the loan in the first place.
Right. Kicking them when they're down almost.
Sort of, yeah. The only real ethical services a lender provided back then were, keeping the gold safe for a while and just allowing the borrower temporary use of that naturally appreciating value.
And debt them. It just got harder and harder to pay back, right? Because the money you owed was becoming more valuable, while the things you sold or your wages might be getting cheaper in gold terms.
Exactly. That's the trap. Debt became a heavier burden over time. And that worsening situation for the borrower, that's really where the idea of usury as this deeply unethical thing came from.
Okay, so that paints a clear picture of the past. But then what fundamentally changed? This is where it gets really interesting, like you said.
Yeah.
How did we get this complete reversal?
Right. And the pivot point, it wasn't really a big theological debate or some new philosophy. It was purely monetary, a change in the nature of money itself.
When did that happen?
The big moment, the final break, was 1971, when the U.S. under Nixon cut the dollar's last tie to gold, the Nixon shock.
Ah, right. Ending the Bretton Woods system.
Exactly. That basically ushered in the era of pure fiat currency globally.
Okay, fiat currency. So money that isn't backed by gold or silver, it's just declared valuable by the government.
Essentially, yes. And critically, it's digital, or potentially digital. Its supply isn't limited by mining. Central banks can, in theory, create almost infinite amounts of it.
And they do increase the supply, right? That's kind of the point sometimes.
They do, regularly, to manage the economy, stimulate growth, whatever the goal is. But the consequence is profound.
Okay, what's the big consequence for the average person?
Inflation, the exact opposite of that ancient deflationary world. Now, the default is that the purchasing power of money decreases over time.
So your savings, they just melt away if you leave them under the mattress.
Right. They lose value instead of gaining it, and conversely, debt. Well, in nominal terms, it actually becomes easier to repay over time because the dollars you pay back later are worth less than the ones you borrowed.
Wow. So it completely flips the script from ancient times. Now, just holding money means you lose purchasing power. Lending it at 0% means you definitely lose.
Exactly. So now, savers and lenders need to charge interest. just to break even against inflation, just to preserve the original purchasing power.
Never mind making a profit, just staying level.
Staying level. So lenders require a premium interest to compensate for that expected loss of value. And suddenly, charging interest isn't immoral anymore. It's necessary. Essential even for the system to function.
So, okay, if charging any interest was the old definition of usury, what does usury even mean today? Does the word still have meaning?
It does, but it's shifted dramatically. Today, usury generally refers only to extremely high interest rates, predatory rates.
Like those payday loans
Yeah.
or really high APR credit cards.
Exactly. Things like, 20%, 30% APR, or even higher on credit cards, or those short-term loans with astronomical effective rates. That's what gets widely criticized as usurious today.
Okay, so it's not the act of charging interest, but the level.
Right. And that's in stark contrast to, say, the modest interest you might earn in a high-yield savings account or a money market fund. Those are seen as just necessary tools to try and keep pace with inflation. Not exploitative, just practical.
It really is about perspective, shaped by the money itself.
And here's maybe the core insight, the ethical equivalence. Charging an interest rate today that just matches the rate of inflation. Ethically speaking, that's pretty much the same as charging 0% interest back in ancient times.
Because you're just preserving the value, not extracting extra.
Precisely. You're just aiming to get back the same purchasing power you lent out.
Okay, this ties into what Joe Brown argues in that Heresy Financial piece, right?
Yeah.
He talks about investing versus lending today.
Yeah, he draws an interesting conclusion based on this whole shift. His point is that in today's inflationary world, investing in productive assets, things like stocks, maybe real estate, gold, Bitcoin, diversified funds, is generally a better path long-term than simple lending.
Why does he say that? Better returns.
Partly returns, yeah. But also, he frames it ethically. He sees traditional lending, especially at rates just barely keeping up with inflation, as somewhat passive, maybe even just extracting value in a system where value naturally depletes.
As opposed to investing.
As opposed to investing, which he argues actively creates value. You're funding businesses, innovation, growth. You're participating in building wealth, not just shuffling existing money around while it potentially loses value.
So he sees investing as having a, quote, higher moral standing in our current system.
That's his argument, yes. That it aligns better with actually building prosperity in an inflationary environment compared to just lending money out at interest that might barely cover the loss of purchasing power. It's a provocative take.
It definitely is. Okay, so let's try and pull this all together. We've covered a lot of ground. What are the key takeaways from this deep dive?
I think there are about 6 main points that really stand out.
Okay, let's take them off.
First, those ancient biblical rules against usury, they made perfect sense in their context. A world of hard money, gold and silver, where deflation was the norm.
Right. Point 1, context matters.
Point 2. Second, in that system, just saving money meant its value grew. So lending at 0% wasn't really a loss. You got back more purchasing power anyway.
Okay.
Makes sense.
Third,
Because of that, charging any extra interest seemed exploitative. It added a burden to borrowers whose debt was already getting harder to repay naturally.
got it. The ethics follow the economics.
Fourth, the big shift to modern fiat money, especially after 1971, turned everything upside down. Inflation became the norm.
Right.
Fifth, this necessitated interest. You needed it just to protect your money's value from eroding. So the ethical focus shifted away from banning all interest, targeting only predatory, excessively high interest rates, modern usury.
Okay, and the last one, tying into Joe Brown's point.
Yeah, sixth. In today's inflationary world, investing in productive assets arguably aligns better with both ethical considerations creating value and financial goals outpacing inflation compared to just simple lending.
That's a great summary. 6 clear points tracing this massive shift.
And what this really shows, I think, is just how deeply our economic systems, the very nature of our money, shape our ethical frameworks, sometimes without us even realizing it.
Yeah, understanding this history, it really can change how you think about your own finances, right? Your savings, your debts, how wealth is built.
Absolutely. It gives you a much richer perspective.
It's a real aha moment, isn't it? Realizing that something we see as a fundamental moral principle, like whether interest is okay, isn't fixed. It can be completely reshaped by the underlying economic plumbing, so to speak.
It really makes you think, and maybe leaves you with a final thought to chew on.
Oh, go on.
Well, if the definition of what's moral in finance can change so dramatically just based on whether money is inflationary or deflationary, What other ethical assumptions do we hold today that might be deeply tied to our current economic system in ways we haven't quite questioned yet?
Hmm, that's a good question to ponder. What else seems normal just because of the system we're in?
Exactly. Food for thought.
Definitely. So we encourage you, listening, to think about how these huge historical shifts might influence your own views on saving, on debt, on building wealth. Maybe you'll look at that interest rate on your savings account or your mortgage just a little bit differently now.